So in this lecture, we'll be discussing about IAS 40 investment property. And we have to distinguish this IAS with IAS 16 as well, which is property, plant and equipment. So here what we are discussing is investment properties. First of all, what is the definition of investment property? Investment property is any property which is land or building or part of a building or land or building both, which is either held by the owner or by the lessee as a right to use asset. So it might be your own property, or it might be a property that you have leased and someone has given you a right to use asset. So that might be an investment property as well. And what is the purpose of having this property is to earn rentals or for capital appreciation, that why you have purchased this property so that the value of the property will be increased, or both, that is rental or capital appreciation or both, rather than for use in the production or supply of goods and services or for admin purpose or sell in the ordinary course of business. Because if that property is used in the production or supply of goods and services or for admin purpose, then this property might be constituted under IAS 16. Or if that has been acquired for the purpose of sale in the ordinary course of business, then this becomes inventory and will be covered under IAS 2. So in order to classify any property under IAS 40, one of the purpose is to earn rental or for capital appreciation or both. This is the basic definition. Now, next definition is about owner occupied property. Owner occupied property is property held by the owner or by the lessee as a right to use asset, and the purpose is to use in the production of supply of goods and services and for admin purpose, and this is basically covered under IAS 16 as owner occupied property. Now with any property, whether it is in IAS 16 or IAS 40, the carrying amount is the value at which we have recorded the asset in the statement of financial position. We also say this as a book value or net book value. So it is the amount at which asset is recognized in the statement of financial position. And normally it's original cost minus depreciation. And what is the cost of the asset is the amount of cash or cash equivalent paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction. So whatever price you are paying, either cash or any relevant amount to get this asset, is called the cost of the asset. And as far as the fair value is concerned, this is basically the market value of that asset. Examples of investment property. Number one, land held for long-term capital appreciation rather than for short-term sales in the ordinary course of business. A building owned by the reporting entity or held by the entity as a lessee and leased out under an operating lease. Operating lease is basically short-term rentals. A building which is held by a parent company and leased to a subsidiary, so in the individual financial statement, that is considered as an investment property, not in the consolidated financial statement. In the consolidated financial statement, that would be an owner occupied property under IAS 16. As well, a property that is being constructed or developed for future use as an investment property is also investment property. So question is, rich company owns a piece of land. The directors have not yet decided whether to build a factory on it for use in the business or keep it and sell it when its value has risen. Not yet decided. Would this be classified as an investment property under IAS 40? Yes, because any property which is not yet decided or purchased for undecided future use, there is an element of capital appreciation, so would be covered under IAS 40. Now, under IAS 40, the property that we have purchased, how to record that property, what is the criteria to record investment property? So first of all, the recognition criteria, when to recognize that investment property in the statement of financial position. Investment property should be recognized as an asset in the SOFP when two conditions are satisfied. Number one, it is probable that future economic benefit related with this property will flow to the entity. And what are those economic benefit? Either in the form of rental or capital appreciation or both. So future economic benefit is important. And the second one is the cost or the value of the investment property, which we are going to recognize, can be reliably measured. If it is a purchased property, or if it is a property under construction, whatever expenditure we have incurred on that, it should be reliably measured. So there are 2 points that needs to be satisfied in order to recognize an investment property in the statement of financial position. Once it has been recognized in the statement of financial position, then the initial measurement criteria, first time recording, an investment property should be measured first time at its cost. And this include any transaction cost associated with the purchase of the property. If that property has been constructed, then whatever is the cost incurred in order to bring this to its usable condition, it's the cost. And if that property is being taken on a basis of lease, then a right to use asset is investment property and should be measured along with, in accordance with IFRS 16 rule, that how to calculate right to use asset. After initial recognition, then every year end measurement subsequent to initial recognition. Now we have choice. An entity has to choose between two options, two models. There are two models given. One is the fair value model and other one is the cost model. Whatever policy it chooses, this is a policy that you can either opt fair value model or cost model. Whatever policy it chooses should be applied to all of its investment property. So one policy for all investment property item. A preferable model is fair value model, because the purpose of having an investment property is to earn capital appreciation. So we should need to know that what is the exact market value at the time of the year end. So under fair value model, after initial recognition, an entity that chooses fair value model should measure all of its investment property at fair value. And fair value, how we can identify fair value if it is not available? There is a separate standard, that is IFRS 13, that deals with fair value identification. And what is exactly fair value under IFRS 13 is, fair value is the price that would be received to sell an asset. Right now we are dealing with assets, so just stick to this definition. Fair value is the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. So that means that asset must be trading in a particular market. There must be an active market from where we can get the fair value or market price. So in order to apply a fair value model, we must have a fair value. An investment property should be measured at fair value, except in the extremely rare circumstances where this cannot be measured reliably, fair value. In such a case, you should apply the IAS 16 cost model. This cost model is same in IAS 16 and IAS 40. Now, if we have recognized fair value model, then every year we have to show investment property at its current market value. And as a result of change in the market value, there will be a gain or loss. And a gain or loss arising from a change in fair value should be reported in profit and loss account. It is a realized gain. The fair value of investment property should reflect market condition at the end of the reporting period. Now, if we want to use cost model, then this is the same as IAS 16 cost model. How we can record this? Investment property should be measured at depreciated cost less any accumulated losses. An entity that chooses the cost model should disclose the fair value of its investment property until and unless that fair value cannot be reliably measured. Now, once a model has been adopted, can we change that model? Once the entity has chosen the fair value or cost model, it should apply to all its investment property. It should not change from one to another unless the change will provide more reliable or relevant information. In short, the purpose must be defined that why you are changing. For example, if you have already opted cost model because of the unavailability of the fair value, and now the fair value is reliably measured and you want it to be transferred to fair value, then this is a justification that cost model can be transferred to fair value model. IAS 40 states that it is highly unlikely that a change from the fair value model to the cost model will result in a more appropriate presentation. It means the preferable model is fair value model, and once you have opted fair value model, then transferring to cost model is permitted, but this is not a good way to convert anything from fair value to cost. Now, accounting treatment of other aspects. So, IAS 40 prescribes the accounting treatment for investment property and related disclosures requirement. An asset held by the entity as right to use asset under IFRS 16 and leased out under an operating lease is treated as an investment property. So, if a property is not an investment property, that which accounting standard is applicable? For example, property intended for sale in the ordinary course of business. This is inventory, and applicable accounting standard is IAS 2. Property being constructed or developed on behalf of third parties, that is construction contract, and we will consider IFRS 15 revenue from contract with customer, and owner occupied property, which is to be covered under IAS 16. Because sometimes it happens that we are using a building or a property partly for owner occupied purpose and partly for rental purpose. So some properties may be partly owner occupied and partly held for investment purpose under IAS 40. If these portion could be sold separately or leased out separately under a finance lease, an entity should account for the portion separately. If the portion could not be sold separately, the property is investment property only if an insignificant portion is owner occupied. So now, for example, if you have a building having 25 floors, 25 stories, then you have to check whether you can split it or not, and what is the significant portion. If significant portion is investment property, then we have to apply IAS 16. If significant portion is investment property, we have to apply IAS 40 throughout, if that cannot be separated out. Now, there is also a possibility that you are using a property for one purpose and now you have changed the purpose of the property. So if there is a change of property, then from investment property to owner occupied property or owner occupied property to investment property, everything is possible. So transfer to investment property or from investment property should only be made when there is a change in use, and how that change is used is evidenced by that, for example, previously we have given a property to on rental basis, now we are using it for production purpose, so there is a change from investment property to owner occupied property. And previously we have an admin function of that property, now we have rented it out, so from IAS 16 to IAS 40. So for example, owner occupation commences, so the investment property will be treated under IAS 16 as an owner occupied property. When there is a transfer from investment property carried at fair value to owner occupied property or inventory, suppose the investment property is held at fair value and now we are transferring it to either 16 or 2, then In 16 or 2, we usually use cost. So the property's cost would be the fair value at the time of change. Suppose, for example, we have an investment property, and that investment property is carried at fair value, and its fair value is 100,000. Now there is a change in use, and either that has becomes owner occupied property or becomes inventory. Now we need the cost. So accordingly, this 100,000 becomes the cost under IAS 16 or cost under IAS 2. Conversely, an owner-occupied property may become an investment property and need to be carried at fair value. An entity should apply IAS 16 up to the date of change of use. It should treat any difference between the carrying amount and fair value as revaluation under IAS 16. Now, suppose we have a property which is under IAS 16 as owner-occupied property, and we were using cost model, and now that has been changed to investment property, and investment property fair value model, we have decided that we want to use fair value model. Now this is, under this we have a book value of 100,000. So before transferring it to investment property, we have to identify fair value, and suppose fair value is 1,20,000. As it is under IAS 16, so any increase in value is revaluation surplus, and we have to recognize this revaluation surplus as per IAS 16 under other comprehensive income. We cannot recognize this in profit and loss account. But once IAS 16 value has been updated, then this fair value, market value, becomes fair value of 1,20,000 for investment property. So we'll de-recognize owner occupied property, and we will recognize investment property debit 1,20,000 and owner occupied property credit 1,20,000. Now suppose a business owns a building which has been using as a head office. This is an owner occupied property. In order to reduce cost on 30th June, it moved its head office function to one of its production center and is now letting this out. So this is a change in use. Company policy is to use fair value model for investment property. The building had an original cost on 1st January 20x0 of 2,50,000 that has been changed on 30th June 20x9 and was being depreciated over 50 years. At 30th June, its fair value was 3,50,000. How will this appear in the financial statement at 30th June 20x9? So first of all, we have to identify depreciation from when we have purchased this 1st January 20x0 till 30th June 20x9, 9 years and 6 months depreciation using a straight line method. So what we identified the original cost per annum depreciation 250 divided by 50 multiplied by 9. This is 9 years depreciation, and this is 6 months depreciation. So book value at the time of change is 202,500. Now market value is 3,50,000, and there is a surplus of 1,47,500 that needs to be recognized in OCI. And now fair value is 3,50,000. So this becomes the cost of the investment property. So that was the accounting model under change. Now, once we have utilized this investment property, or if we have sold this investment property and we are no longer utilizing this investment property, then we have to de-recognize this investment property. And de-recognize means eliminate. So one of the situation is when the property has been disposed of or when it is permanently withdrawn from use and no future economic benefits are expected from its disposal. Remember, if it's a temporary withdrawal, then we will not de-recognize this property. But if it is a permanent withdrawn from use, no future economic benefit are expected, then we have to de-recognize this from the statement of financial position. And at the time of de-recognition, any gain or loss arising is always shown in profit and loss account as income or expense. If there is any compensation received from third party for investment property that was damaged, like insurance or other thing like that, it should be recognized in profit and loss account as an income when the compensation becomes receivable.